Forget the guns. Forget the backroom deals. The Mafia's real power wasn't violence. It was finance. They built a shadow bank that moved billions, and its blueprint was later copied by the same Wall Street giants that run our economy today. This isn't just history. It's a warning. Today, you'll see how the Mafia engineered money outside government control, why its collapse destroyed ordinary families overnight, and how those same patterns are embedded in your financial system right now. The Prohibition Era looked like chaos. Booze, bullets, bribery. But beneath this storm, the mob confronted its first financial puzzle: how to convert illegal profits into untraceable power without leaving paper trails. Al Capone's syndicate became an engineering team, crafting pipelines for money through laundries, pawn shops, and real estate fronts. Dirty cash reappeared as clean credit, feeding new businesses and corrupting legitimate economies. The solution required inventing rules outside traditional banks, layering assets through shell companies, creating respectable-looking fronts, leveraging fear as collateral that guaranteed repayment better than any contract. Capone mastered the art of the front business, transforming speakeasies into legitimate storefronts on paper, while cash flowed through constructed channels crossing state lines. The innovation was brutal in simplicity. Create enough layers that authorities could never trace the origin. $1 from illegal whiskey in Chicago would pass through a laundromat in Gary, a trucking company in Detroit, and a restaurant supply business in Cleveland before emerging as legitimate profit from a New York furniture store. Each business owner became a cog, often unknowingly participating in a machine that converted crime into respectable wealth. The syndicate discovered moving money required more sophistication than moving merchandise. Banks asked questions about large deposits. Federal agents watched suspicious transactions. So the mob built parallel infrastructure. Loan sharks charging rates no bank could match, but requiring no documentation. Enforcers guaranteeing repayment with methods no court would sanction. And bookkeepers maintaining dual ledgers. This shadow system processed millions annually through networks spanning the country with mechanical precision. Yet its foundation was sand. The moment trust fractured, the moment one operator talked or one account was exposed, entire networks collapsed. But the system's genius was also its fatal flaw. It could never become legitimate without exposing its criminal roots. Every dollar cleaned was a brick in a wall designed to collapse. As the underworld refined its empire, ambitions grew into institutional power, targeting the one resource that could transform organized crime into organized finance: pension funds. Enter the Teamsters Central States Pension Fund, the Mafia's unseen central bank. Working-class savings transformed into syndicate capital. By the 1970s, this fund controlled over $1 billion. Money from truck drivers and warehouse workers who trusted union leadership to protect their retirement. No violence at the surface, just paperwork masked in respectability, signatures on loans, handshakes between union officials like Alan Dorfman and casino developers answering to Meyer Lansky's financial architecture. Las Vegas transformed from desert to neon wonderland. All financed with Teamsters loans no traditional bank would approve. The mob integrated underground economy with legitimate finance so seamlessly that investigators struggled to identify where legality ended. The fund became perfect. Billions in contributions, minimal oversight, leadership approving loans based on loyalty rather than creditworthiness. Hotels rose in Nevada. Golf courses bloomed in California. Resorts opened in Miami. Behind each stood silent partners, whose names never appeared on deeds but whose influence determined every decision. Politicians accepted contributions and looked away. bankers remained silent. Small business owners accepted favorable loans, unaware they were now obligated to a system demanding absolute loyalty. Federal pressure increased. Offshore accounts in Caribbean havens, coded messages through intermediaries, shell companies layered so deeply, ownership became impossible to trace. Every loan was a ticking bomb. One leak, one raid, and hundreds lost everything overnight. The Pizza Connection case exposed the scale. Federal agents discovered selling pizza wasn't the main business. It was a financial pipeline. For every $10 in the register for food, investigators estimated another $90 in heroin money was deposited alongside it, laundered and wired to Swiss accounts. Pizzerias across America were functioning ATMs for a global narcotics empire. Each was a node in a web spanning continents, connecting Sicilian suppliers to American distributors to European bankers. Money entered dirty in Palermo, traveled through New York pizza parlors, and emerged clean in numbered Swiss accounts. Yet decay arrived inevitably. Informants appeared. Federal investigators learned to follow money trails using the RICO Act, passed in 1970 and weaponized against Mafia financial structures. The pattern etched itself. Every shadow system eventually faces exposure, and when trust fails, the gears seize, sending shockwaves through entire communities. Today's financial landscape, shadow banks, off-balance sheet vehicles, structured products, echoes the Mafia's innovations with disturbing precision. Modern credit markets, securitized debt, offshore structures, and unregulated lending copy the mechanics that powered organized crime, just with new labels and legal veneer. The principle remains unchanged. Power flourishes where transparency dies, where complexity obscures accountability. Like those syndicates, present systems run on confidence, insider agreements, and relentless drives to outpace regulators who arrive years late. The 2008 crisis revealed the pattern. Shadow banking entities held trillions, operated outside oversight through legal loopholes, and when confidence evaporated after subprime collapse, the entire structure threatened global meltdown. Lehman Brothers, Bear Stearns, AIG. Institutions employing Ivy League graduates in glass towers, yet replicating the same architecture. Massive leverage, opacity hiding risk, absolute dependence on continuous confidence from counterparties who never fully understood what they were buying. When trust broke in September 2008, the machinery seized exactly as when mob networks collapsed under RICO. The Financial Crisis Inquiry Commission documented how these institutions created complex credit default swaps and collateralized debt obligations even their own risk managers couldn't explain. Layering financial products like Capone layered front businesses, creating enough complexity that regulators could never trace true risk. The more our finances are centralized and surveilled, the more algorithms replace handshakes. The more people seek safety. They look for refuge in physical assets, private transactions, anything beyond the system's reach. The Mafia's shadow banks collapsed because they couldn't sustain contradictions between criminal origins and legitimacy aspirations. Modern shadow banking faces different contradictions between complexity and comprehension, innovation and stability, private profit and public risk. Our present is haunted by the same vulnerabilities that destroyed the Teamsters Fund, and every mechanism carries its embedded warning. So what did that collapse actually look like? When the Mafia's shadow banks crumbled under RICO prosecutions in the 1980s, when key figures like Alan Dorfman were murdered to silence testimony, when the architecture was exposed in courtrooms, there were no bailouts, no safety nets, no rescues for ordinary participants. Families lost life savings in a single night. Businesses built on friendly loans vaporized when lenders were imprisoned or killed. Communities fractured with no compensation. Teamsters who paid into their pension for decades discovered accounts had been loaned to casino projects that never repaid, to golf courses existing only on paper, to hotels serving as money laundering vehicles. Department of Labor investigations documented pensioners receiving pennies on the dollar or nothing at all, while union officials lived in luxury. Small business owners who accepted favorable financing became targets of federal forfeiture, losing property because they'd unknowingly participated in criminal conspiracy. The machinery ground them up without distinction between willing participants and innocent bystanders. Yet some anticipated the fall. The survivors had one thing in common. They didn't trust the person making promises. They trusted the structure of the deal. They asked one simple question: if everything goes wrong tomorrow, do I still control my assets? Or does someone else? They followed a simple blueprint: diversify assets so no single seizure could be fatal, operate outside closed networks, and safeguard value in its most resilient forms: physical gold, real estate with clean titles, or businesses with transparent books. They understood any system promising extraordinary returns with minimal oversight was engineering its own destruction. They studied mechanics of financial relationships, understood counterparty risk decades before the term entered common usage during 2008, recognized that promised security often masks fragility. They maintained escape routes when others grew comfortable. They verified rather than trusted. The lesson carved into every collapse is identical. Those who survive master custody of their wealth, maintain sovereignty over assets, refuse to surrender control for convenience or higher returns promised by institutions whose operations remain opaque. Even empires of intimidation are ultimately engineered by trust, and trust fails first when contradictions become unsustainable. The Mafia's rise and fall was about creating an underground financial system that grew too confident, too complex, too exposed to maintain contradictions between criminality and legitimacy. That collapse destroyed fortunes in the blink of an eye, erasing decades of wealth with raids, prosecutions, and inevitable disintegration of networks built on secrecy rather than transparency. The pattern echoes across financial history. The Teamsters who lost their pensions, the business owners who faced forfeiture, they all paid the price for trusting a system whose foundations were sand. Today, the machinery is larger, the stakes are higher, and the warning remains urgent. When trust breaks, when opacity can no longer hide fragility, collapse arrives suddenly and shows no mercy to those who failed to prepare. Protection comes from understanding financial architecture rather than trusting promises, from maintaining custody and control rather than surrendering for convenience, from refusing to participate in deliberately obscure structures. History doesn't repeat, but if you ignore it, it will crush you all the same. In the ruins of failed banks and broken pensions, the historical echo is clear. Humanity has always searched for incorruptible money, for systems no empire can confiscate, for value answering to mathematics rather than ministers, to algorithms rather than decrees. Sometimes in gold, sometimes in code, always seeking what institutions could never provide. If this analysis opened your perspective, subscribe to the Financial Archive to decode other patterns hidden in financial history. The answers are in the past, waiting for those willing to learn before the machinery seizes again.